Welcome to another episode of AusBiz. Here we are again. My name is Bryce, and as always, I'm joined by my equity buddy Ren for more content on reporting season. How are you going?
I'm very good. What a strong way to start the week with a dejected "Here we are again." Come on, mate. I want to see some enthusiasm.
I was going to throw a joke about a reporting season, but thought I'd wait to introduce ourselves first.
Okay, all right. Well, the floor is now yours. What's
no,
the
we've
joke?
missed it. We've missed it. We've missed it. It's time to move on.
All right. Well, let's move on. Bryce will crack that joke at some point in this episode. We are here for another week. We have been talking a lot about reporting season because there's so much information we're learning. You know, we learn every reporting season, but this one in particular, because of everything that's going on with COVID and the lockdowns, it has been a reporting season rich with information. And as we start to wind down and get to the other side of it, we thought, let's get an expert on who's keeping a close eye on everything to get his take on what's been happening.
Absolutely, and it is our pleasure to welcome back to Equity Mates AusBiz one of our good friends, Owen Raszkiewicz. Owen, welcome.
G'day, fellas. It's always a pleasure.
Always a pleasure. We love having you on, always providing a lot of insight, and our audience love hearing what you have to say as well. So we are going to chat all things reporting season. We know you've done a lot of content and analysis on it over at Rask Australia as well. So to our audience, go and check that out if you'd like to know more about what Owen is doing. But Owen, let's start at the top. What are some of your key headlines, I guess, or key takeaways more broadly from the reporting season?
Yeah, sure. So I know we're going to talk about a few companies today, but I guess generally a lot of companies reported what they call a tale of two halves. So you had typically a first half that was a bit rough for a lot of companies, and the second half which bounced back, particularly for companies that were focused on a global audience or a global customer base, which includes some of the companies that we're going to talk about today. And obviously big dividends with Fortescue Metals and CBA and the like coming out. Who doesn't love dividends?
Who doesn't love dividends? The catch cry of every Australian investor there, Owen. But you're right. You did share 5 companies that I guess caught your eye in particular, and we want to I guess go through them one by one just to unpack them and hear what caught your eye in particular. They may not all be good. We didn't check that before with you, so we'll see. But let's start with one that I'm pretty confident you're going to have good things to say about because they reported a very strong set of results, and the market very much appreciated it. And that was WiseTech, ASX ticker WTC. So what caught your eye about WiseTech?
So if there's one metric to focus on with WiseTech, it's the cohort analysis. So in this year's presentation, it was right down the back, and I was searching for that. And basically what that shows you is the number of people or number of customers that are continually using the platform, and it breaks it down by year. So you can see, for example, the customers who took on CargoWise One software, which is WiseTech software, in 2014, how much have they spent all this time through to now? And what that shows you is, one, the platform is very sticky, and 2, they're spending more. So that's the sign of a strong competitive advantage when you can raise prices and increase usage. And the customers don't leave. So WiseTech reported some great results. I've got EBITDA here up 63%. Free cash flow was really impressive. And I think the big thing for WiseTech, I think it ended at one point it was up 50% in a single day. And this is a multi-billion-dollar company. And there are 2 reasons for that. The first reason is outstanding performance operationally, but the second reason is it was heavily shorted. So people had bet against WiseTech for a myriad of reasons, but it just blew them out of the water, or blew them off the screen, literally.
Wow. It's certainly got a lot of media attention. So one to watch. It'd be great if you could get cohort analysis for podcasts as well, and see if people stick around year on year. Anyway, so another one, Owen, is Nanosonics, ASX ticker NAN. What caught your eye about Nanosonics?
Well, so we actually wrote up Nanosonics in an analyst report the week before they released results, and that's always a risk because we came out and we said that the shares are probably fair value, and then they came out and reported, and shares jumped 24%. So, I guess the key takeaways for Nanosonics, if you're looking at that business, is it's very clear to plot how much revenue they earn from capital revenue and how much they earn from consumables and maintenance. So Nanosonics sells, it looks like a microwave for hospitals, but it disinfects ultrasound probes. And so they make revenue in two ways, effectively. The one is via an upfront sale of that machine to hospitals. It's called capital revenue, and that was down slightly, if I'm not mistaken. But the other one, which is consumables revenue, showed some pretty good traction. And, hospitals were closed in North America, which is where they operate for a large part of the year. But the second half of the year was really strong. Furthermore, Nanosonics released an update saying that they're going to move into endoscopy. So outside of just traditional ultrasound probes, this is a massive market for them. And finally, they increased their TAM estimates, the total addressable market, from 40,000 units to 60,000 units, which is actually what we believed its total addressable market to be. So for a business that's been a bit sleepy for a while, it was a really good result.
So Owen, continuing on the theme of companies that are reporting strong results, Net Wealth, ASX ticker NWL, reported a big jump in their market share from where they were a few years ago. So what caught your eye about Net Wealth?
Yeah, great one, mate. So Net Wealth is a business that is a platform. So it's a software business created a platform that allows financial advisors to take their clients' money and manage that and invest it in funds. So it's a great platform. It's a very sticky platform, and you're just spot on, mate. Like the key thematic for Net Wealth is that it's taking share alongside Hub24, which is another ASX was a business that did really well. It's taking share from the big banks, and because it's such sticky software, financial advisors love it because it's easier. It's got more features than most of the other platforms. And advisors can actually earn a fee from managing clients' money on there too. And you can even put things like super on some of these platforms and manage everything in one place. So the key thing to watch for Net Wealth is how much share they take from the incumbent banks and places like IOOF and that sort of stuff, or IOOF. And then look at the margin that they're getting. So the margin was a little bit compressed if you just look at the margin that they make on the funds under management. But at the same time, the margins can come down a bit because they're growing so fast. So falling margins isn't always a bad thing. I mean, it's not great, but it's not always a bad thing if you're growing as fast as Net Wealth is.
So yeah, on that growth, Owen, we read that they've gone from about 1.5% market share to just over 4% in the last few years. Based on your analysis, do you have a projection as to what that could be over the next 5? Like if you're thinking about what the business could be worth, where do you think this business could go?
Yeah, I think so. I don't have my DCF in front of me, but basically, we would expect it to be in double digits in the next 5 years because a big catalyst for Net Wealth over the last, say, 3 to 4 years has been the Royal Commission. So that kind of spurred a lot of financial planners to move away from the big banks. And obviously, the banks dropped their financial advice arm. But at the same time, it's important to remember that the way people engage with investing is changing too. So take Equity Mates, right? Like you guys went around 5 years ago, or at least you weren't anywhere near as big as you are today. But you're educating people through your podcast and now through your book. And people are able now to use tools such as Net Wealth to go direct. So the mix of the market is changing. So I wouldn't want to say don't just focus straight on that percentage of the overall advised market. Net Wealth also now has funds under management, so you can invest directly on the platform as opposed to just funds under advisement. So there are two metrics there. We expect double-digit share of financial planners, but there's also all the other things that they're doing, in direct investing and with portfolio management as well.
Well, Owen, I'm glad you got a mention of our book in there. Appreciate that. That was unpaid and unprompted, but we'll send you a 6-pack after this.
Of books, a six-pack of books.
Yeah. So the next company that caught your eye this reporting season was EML Payments, ASX ticker EML. What about their report caught your eye?
Yeah, well, this is a really interesting one for us. So we recommended EML quite a while ago, and then not long after, it actually fell 40, I think it was 42% in a day. So this is just like me coming on the show and just confessing to all my sins. But basically, what happened is they bought a company based out of Ireland, which had a regulatory clearance over there. It's called Prepaid Financial Services. Bought that from two vendors, a husband and a wife. And what ultimately happened, or what transpired, is that the CBI began investigating PFS. you may remember PFS because EML does like card payments and virtual card payments and all that type of stuff. And what happened during COVID is they'd already agreed to this massive acquisition of PFS. And then during COVID, they basically, it seems like they almost pulled out of the deal, and PFS said, "Oh no, we'll give it to you a lot cheaper." So then they got the deal over the line at a reduced price. And then later on, it was revealed that the CBI, the Central Bank of Ireland, was investigating them for potential concerns around compliance, which is something that all monetary authorities should do for anyone that has a banking license. But basically, the market overreacted, and then they came out with their annual results. Organic growth up in the 60% range. I'm sorry, that's both acquired and acquisitive growth. Organic growth still ticking along in single digits, but strong growth considering the year that we've had. And they also provisioned about $9 million for the CBI investigation. We expect higher costs in time and lower margins. But other than that, I mean, this is a really resilient business, really sticky, and it's good to see it back above its levels from where it was when it took that hit.
Mm. And then, Owen, to close out on the conversation around stocks, there's one here, Redbubble, ASX ticker RBL. What was it about Redbubble that caught your eye?
Yeah, so Redbubble is a really interesting website and platform, I should say. So this is probably one of the most divisive companies in the Twitter sphere. If you go onto like Reddit and on Twitter, you'll find that there's a really strong bull case for Redbubble becoming a global platform where you can buy and sell creative, independent art. And then there's a real strong case to say it's basically, a glorified retailer that's going nowhere. I think, this is another company that was heavily shorted. So it started the day down, I think, about 14%. This is in a single day, down 14%. I remember dialing into the investor call and thinking, geez, I didn't think it was that bad. And by the end of the day, it ended up, I think it was over 20%. So a 30% reversal in a single day. This is a business that is still growing its artists, even in spite of COVID unwinding, because that's a big issue because fewer people are locked up at home buying Christmas gifts online. So Redbubble actually loses from people coming out of COVID. So that was a kind of a concern for the market. But to see, it still managed to, over the full year, break even on a free cash flow basis. It's got cash in the bank. It's growing its artist count, and importantly, more users are coming through the mobile app rather than the website. A few years ago, Redbubble got smashed around because Google changed its algorithm, which meant it was harder to acquire customers. So that's all kind of slowly deflecting now. So Redbubble, really interesting business, really high risk, but a really interesting Australian global success story.
I don't know a lot about Redbubble other than I've seen a number of people tweet a lot about it, but those tweets have never really prompted me to look into the business. From what you've just described, is it basically an Australian version of Etsy?
Yeah, so it's just a little bit different to Etsy. So Etsy basically so think of Redbubble as a one-stop shop. This is why artist attrition on the Redbubble platform is so low, is because once you go to Redbubble, you basically just click a button, upload your designs, and anyone in the world can purchase that. And it'll be automatically manufactured by a manufacturer that Redbubble has chosen anywhere around the world and be delivered to you. Etsy is a little bit different. Etsy is more like a marketplace where you can still have that functionality, but you need to kind of bolt things into it to make your profile or your platform able to manufacture and distribute designs to people. So Etsy is the bigger cousin, if you like, not a direct relative in terms of like what it's actually doing. Redbubble, it competes against companies like Society6. And so it has those types of competitors, which are still small. I think one of the big concerns from a competitive front end is just that, we've got things like Amazon Homemade. If you're aware of that, it's one part of Amazon that's allows people like independents to upload their creative content. And that's both a threat to Redbubble and to Etsy.
Well, Owen, the last two answers have made me realize how little I know about the creative e-commerce space. So you've set me some homework here. I'm going to go and brush up on that. And we'll have to get you back on at some point to, I guess, talk about that whole world. But unfortunately, we have run out of time. So we want to say a massive thank you for joining us today. And if people want to see more of what Rask Australia, Owen and his team are putting out, there's some great content on their website, so go check that out.
Thanks for the shout out, guys. Really appreciate your time.
No worries, Owen. And that brings us to the end of today's episode. Big week coming up, as always. Reporting season wrapping up, Ren, and boy, are we covering it all.
Yes, but it won't be a full week of reporting season. We will be covering it tomorrow, though. But after that, we've got Watchlist Wednesday with 3 micro caps. We know how much people love hearing about stocks they may not have come across before. And then we're going to close it out by going over to the States and looking at...
Really?
We're going on tour. And looking at the FTC's refiled case against Facebook and what that might mean.
So plenty coming up, and we'll see you tomorrow.